Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Intuitive Machines Inc. Annual Report. Intuitive Machines Inc. offers a wide range of services and products to support the growing space industry. At its core, the company provides delivery services for payloads such as satellites, scientific instruments, and cargo to various destinations in space. This includes rideshare delivery and lunar surface access. In addition to transportation services, Intuitive Machines also offers data transmission services, which involve collecting, processing, and interpreting space-based data using AI applications. The company's infrastructure as a service solutions provide navigation, maintenance, scientific data collection, and system health monitoring capabilities. The company has developed several innovative products to support its services, including the Nova-C lunar lander, Micro Nova Hopper propulsive drone, and Nova-D payload transport vehicle. These vehicles are designed to meet the demands of the emerging lunar economy and enable sustainable exploration and development of the moon. Intuitive Machines also provides a lunar data network, which enables efficient communication between spacecraft and ground stations. The company's products and services cater to various customers, including the U.S. government, commercial entities, and international clients. Intuitive Machines, Inc. market capitalization of $3 billion is materially smaller than most of its industry peers of roughly $6 billion. Intuitive Machines, Inc. trades at a lower price-to-book ratio of -2.86 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation, signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 99% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline in the aerospace and space industry can be categorized into several key areas. Revenue growth was primarily driven by companies with significant contract liabilities and deferred revenue, such as SNS. These companies were able to capitalize on existing contracts and commitments, resulting in increased revenue. Additionally, grant revenue from government agencies or other organizations contributed to revenue growth for some companies, like the Texas Space Commission. On the other hand, revenue decline was often attributed to high cost of revenue and operating expenses, which overwhelmed the financial performance of companies such as IX, LLC joint venture. Furthermore, net operating losses reported by several companies indicate a need for further investment or restructuring to improve their financial stability. In conclusion, the primary drivers of revenue growth or decline in the aerospace and space industry are complex and multifaceted. However, it is clear that contract liabilities and deferred revenue, as well as cost of revenue and operating expenses, play significant roles in determining a company's financial performance. The net income of the company underwent a significant change between 2024 and 2025. Initially, it experienced a decrease in net loss by $240 million, indicating an improvement in financial performance. However, this was followed by a slight decline in net income attributable to non-controlling interest by $1,988. On the other hand, profit margins worsened by $22.6 million during the same period. This can be attributed to increased costs to be incurred exceeding estimates of total consideration. The operating loss margin also decreased by 16.5% from 2024 to 2025. Despite these negative changes in profit margins, there were some positive developments that contributed to an overall increase in net income. Changes in contract estimates and the recognition of revenue from previously unsatisfied performance obligations helped improve net income. Additionally, the reversal of previously recognized losses also had a positive impact on profit margins. Based on the extracted summary, it appears that there are conflicting statements regarding the company's operating cash flow. However, upon closer examination, it is clear that page 50 provides a direct and reliable source of information, stating that the company has been generating negative operating cash flow for both years. This suggests that despite some ambiguity in other pages, the most accurate assessment is that the company is not currently generating positive operating cash flow. The conflicting statements on pages 52 and 72 do not override the clear and direct information provided on page 50, which should be considered the most reliable source of information. The company's debt level has undergone a significant change over the past year. Initially, the long-term debt was at $0, but it increased to $335,335, indicating a substantial rise. This increase is also reflected on pages 88 and 112, further emphasizing the significant change in debt level. Regarding interest expenses, there have been notable changes as well. On page 44, it is mentioned that the interest expense has increased significantly due to convertible notes. Similarly, on pages 46, 48, 50, and 112, it is stated that the interest expense has increased from -$92,000 in 2024 to -$4,177,000 in 2025. Indicating a significant increase of $4,085,000. The presence of convertible notes, as mentioned on page 89, also contributes to the increase in debt level and interest expenses. Overall, these changes suggest that the company's financial situation has undergone a substantial transformation over the past year. The management is optimistic about the company's future prospects, citing its well-positioned business for continued growth and expansion. To achieve this goal, the company is investing heavily in research and development initiatives to enhance product and service capabilities. Additionally, it is prioritizing business development through acquisitions to support its growth plans. The company's backlog provides a positive indication of future work on awarded contracts, which will contribute to its revenue growth. However, management acknowledges that cash flow management may be impacted by significant judgment and estimation in determining total revenue and cost at completion. To finance its growth plans, the company has entered into debt agreements and equity financing arrangements. It is also aware of potential risks associated with changes in U.S. trade policy, which could affect its supply chain and business operations. While the company's strategy appears to be focused on growth through investments and acquisitions, there are some areas where its outlook may be unclear or subject to change. Specifically, contract performance has been a concern, with losses experienced on certain contracts. Nevertheless, management remains committed to achieving its growth objectives through strategic investments and expansion of services. The company has a history of distributing value to its shareholders through various means. One such method is the payment of dividends, which has been consistently practiced by the company as evident from multiple references in the provided summaries. The payment of dividends demonstrates the company's commitment to returning profits to its investors. In addition to paying dividends, the company has also engaged in share buybacks, a strategy aimed at increasing shareholder value through the reduction of outstanding shares. This move is also reflected in the summaries, highlighting the company's proactive approach to managing its capital structure and rewarding shareholders. There are concerns about inventory buildup and supply chain disruption that could impact the company's operations. One concern is inventory buildup due to backlog, which could be exacerbated by difficulty qualifying new sources of supply or implementing use of replacement materials. Supply chain disruptions are also a significant risk, with potential causes including counterparty risk on contracts with customers, prime contractors failing to fulfill contractual obligations, and indebtedness exposing the company to risks that could affect inventory buildup or supply chain. The company's dependence on U.S. government contracts, which are heavily regulated and audited, may indicate potential for supply chain disruption. Furthermore, there is a risk of not being able to obtain sufficient materials or supplied components to meet manufacturing and operating needs, with limited capacity available from lunar lander launch providers and reliance on a limited number of suppliers for certain materials and supplied components. Launch failures, imposition of tariffs on raw materials, and prolonged disruptions in the supply of key raw materials or components could also have a material adverse effect on operations. Additionally, global pandemics, infectious disease outbreaks, and public health crises have disrupted business in the past and may do so again, leading to supply chain disruptions. Market disruptions due to ongoing military conflict and sanctions could lead to significant volatility in commodity prices, while inflationary environment affecting price and availability of products and services is also a concern. Overall, these risks highlight the need for careful management of inventory buildup and supply chain disruption to ensure the company's continued operations. That concludes the financial summary for Intuitive Machines Inc. Feel free to comment below, and I will be happy to answer them when possible.